Good morning, ladies and gentlemen. Good morning, ladies and gentlemen, and Ivan. I can just see you there. Morning, Ivan. Good, good morning. Good morning, Anna Marie. Goeiemorgen. Didn't know I'd learned the Afrikaans language the last 20 minutes, did you? That surprised you. And you notice I say Ivan Olivier, not Oliver. So there you go. Getting somewhere. Hello, Marcus. Good to have you back. I don't know if you saw the other day because I got caught doing the live chat, and then I got quite a big call coming up. And by the time I got back to you, you'd already left. If you do everything trading or anything like that, you come WhatsApp. You got my details. Come straight to me. Don't have to go live chat. Anything to do with the technical side or whatever, then you can go to the live chat. Just so going forward, that applies to everyone. Anything to do with trading, I can't help you with technical stuff, stock market, whatever. That's not my department. But tend to do trading, because I'm licensed to advise, they will have to pass it back to me. So I go through the preamble around the buddy, like through all the buddy departments, just come directly straight to me. I think you've all got my WhatsApp. I'll post it again later on once we started, just so you know. Okay, yeah, thanks, Marcus. Yeah. Well, you can. It's up to you. But explained to a couple of people called up about it. We might have a bad one the other day. Now, obviously, golf. You bogeyed the bogeyed the last hole, but doesn't mean to say you're going to bogey the next one. I was just watching the tennis, by the way, and Pete Sampras was once quoted. I know he's retired now. I thought he was brought up in commentary. A quote says, "To be successful in tennis, I strongly advise you have a bad memory." And I did laugh at that. It's not a bad point. Our memory of the past fears often corrupts our present. Just because you lost last time didn't say you're going to lose the next time, or just because you won last time didn't say you're going to win this time. You know what I'm saying? So yeah, that was then, this is now. So I'm hoping it's going to come right. Okay, that's why. And Beatrice, that's exactly how the cookie crumbles. I'm not sure you get many trades today with the CPI coming out, but that takes precedence, guys. Very important. It takes precedence. Thomas and I started early. Never mind. It takes precedence. So if I'm just going to go and share, before I do that, just to explain, you can unmute or, as you know, post in the chat line. Anybody new? This is not a trading aspect. It's a practical learning curve where we discuss trade ideas, we clarify stuff we're not sure of, etc.
Or maybe your camera's not working, or maybe
could be.
I'm very sorry. I've just started the trading room, so I'll only be able to look up. That's what I finished because I'm in the trading room.
Okay, I don't know.
Okay.
I'll maybe.
Okay. For now. Let me leave because anyway.
Just a second. Just quite a second. Just want to explain. Just let these guys in. So you can unmute. If you are not interacting with the trading room, please keep muted if you've got background noise, because then we can't understand what's going on. We can't hear us, obviously. So a lot of time I'm sort of explaining out what should in theory be common sense. But you can always put chat line on there. If you're not sure of something, ask, Anyway, so basically it's 30:30. I'm going to share now. Is there going to be a war room for the CPI? There very much so. It's going to be a war room for CPI, Marcus. Non-farms war room for both CPI and non-farms will be there until otherwise, but I can't see any reason why there shouldn't be, because it's so important. Okay. Now, before we come to that, I've just got to do something quickly, like share and post. Someone wants to join the trading room. You seem to have lost the Zoom ID. So I just wanted to give me a second as I just copy and paste through. Second. Okay. Okay, say morning to everybody. Right. Just want to read some of this I might have missed. Often get important stuff. NZDJPY for long. We'll go straight to that because it's already a signal. You received it, so need to go over that. Hearing it. You're not. NZDJPY. Go to that. Well, as you look at that, morning. Is there going to be a war? Absolutely. So here's a doozy. I followed the signals one too to buy, but decided to come in at one. Yeah, that's fine. Yeah. Then fear kick me out as I got the bottom line. I'm not sure if Fear came in. If she went in at a better price, remember if it says getting a 159 to buy it, obviously not sell it, buy it, and it's 158.75, that's 25 pips better. What a pity, it should have stuck with anyway, it's always hindsight. Never mind. Okay, one of those things. You can be there, but I'm only opening up at 5 to 2 myself because I've got to open up and then admit. Friends on the way to stop, not anymore, is it? Or is it going back to stop loss? Saw the bounce last I looked this morning. Yeah, well, we'll keep your fingers crossed. Anyway, we'll see. Just let these guys in. Well, I'll never suggest you move the stock away from entry to increase risk. I certainly won't do that. Whether you do or not, it's your choice, but I'm certainly not going to do that. No. You worked out, I hope you worked out your calculations. I'm prepared to risk because you're a disciplined person. Not just you, but everyone's. Let's say a disciplined person. I can afford to risk 10 units on this one. If you start modifying away, not 10, you'd be risking 11, 12, 15, or whatever it happens to be. Sometimes you come right. Well, we've all done it, and I certainly admit I have. Don't want to encourage it though. And often, I mean, I did the other day very wrongly, and it didn't help me out at all. I mean, luckily I could still afford the knock, but I was annoyed with myself because I preached not to do it and then I did it myself. But sometimes you come right wrong. But the problem is, again, going back to this area, it's purely psychology where you can't handle the loss, so you move it away, so you get a deeper loss. And most of the time, we talk about hitting target. The stop loss and TP is a target. When it goes against you, nearly always hit target, the stop loss, but very rarely hit target the TP because often you modify too close, you're stopped up, nowhere near the TP, or you say, well, I'm a profit. You see the ups and downs. I'm up 100. I'm down 50, up 150, up 50, up and down, and you take it, and then it goes on and hits the TP or whatever. So it does take a bit of discipline to remember the basic maths behind it. If you're going to hit the the target every time with the stop loss, or modify the stop loss away, you just have to lose one trade to make up the 5 or 6 winners. You're grabbing your profit very, very quickly. And that is the psychological one of the major reasons, not the signals, not market movements, why guys suddenly scratch their heads and the guys are telling me our last 6 signals out of 10 were good. How come I'm losing money? Because the 4 that knocked you out, you lost 400 units. The 6 that you took profit on, you only made 100. So you actually won more than you lost in trade success, but the net was down because you grabbed your profit too quick. Remember the maths behind it. And I know it's difficult when you start because the mentality, the emotions, the fear is so big. That's why I say, guys, try and get off the demo and get into this live as quickly as possible so you can control and discipline those emotions. Always remember that because, as I say, we curse when our sports hero misses a kick or whatever, but most of the average person cursing couldn't take thousands of that pressure. Because as soon as they do, they crumble, yet they dish it out to the sports star. Try and get the discipline of taking the pressure off it. And look what I have. I'm not looking at my trades, am I? I've got it pushed down there out the way. So I'm not going to let it play with my head. Okay. And make sure you get your sodding volumes right. So if you do get stopped out, like one guy did today, and he's very upset, and he had the risk, and he went in something like 5 or 6 times too big. Ordinarily, all his eggs in one basket. Is about 40–50% of his entire capital exposed in one area, doing all right. It's the AUDUSD, by the way. and then it suddenly pops up, and now he's an unhappy chappy. It's not the signal's fault, it's not our fault, it's not Quick Trade's fault, it's not the market's fault. You were driving at 300 Ks in 120 zone. You're speeding, basically. Okay, hope that's all clear. But it shouldn't be giving you that's my whole point. It shouldn't be giving you sleepless nights. It's giving you sleepless nights. You went in too big. You've got to accept when you go into a trade, you've got to prepare to lose on that trade. If you can't afford to lose in that trade, reduce your volumes. And if you still can't handle it, then find something else. Put your money in a fixed deposit or something. I don't know. But you can't go in so big you're getting sleepless nights. That is when you're overexposed. I know Chris well enough now. I think he's fairly a bright lad and understands. He's probably laying on a bit sick just to make a point. But I'm extrapolating what you're saying, Chris, for everyone else, because a lot of guys are not getting this. They're going in too big. They're not looking at it. Most companies won't even put 0.01 in. Never mind 0.01, 0.02, 0.03, 0.04. So it's clearly spelling out the basic what the risk is. And if you say, right, I've got 5 grand and 0.04 is going to be, let's say, 500 risk, and I go in for twice that or double up. Now I'm horrendously overexposed. If you've got a risk of 1,000 rand on a 5 grand balance, what's 1,000 as a percentage of 5? Well, that's 20%. 20%. I've seen guys 40, 50% of their entire capital at risk in one trade. Last time I went in, I made 100% in 5 minutes. Yeah, and then the next one you go in, you lose 100% in 5 minutes. You get the idea. Try and build it properly rather than try and get from Joburg to Cape Town in your motor car, 6 hours traveling at 300. You might be lucky, but most times you probably spend quite a lot of time in jail at best, maybe even have a fatal accident. Just keep an eye on things. Okay. Oh, well, stick it out, Brent. We haven't hit the stop. Let's just have a look at these trades. What is the stop anyway? I've got it written down. Hang on, give me a second. Well, I think it was 80-40 or something like that. Where is it? Been a couple of days. Where's Brent? Brent. Where's it now? To read Brent. I'll find it. It was the day before that. All these bits of paper. Brent. I think it's about 80-40. Can't seem to find the moment. So it's not your stop loss. Look at Brent. So sorry, Hannah, I was supposed to talk about this one here. Brent. So I'm cleared out. 79, over $1 away from the stop. So let the trade run. You've got your strategy. Give it a chance. If you're panicking, you're overexposed, or you're mentally not understanding what's going on. Let it run. Look at it. You've got your strategy. Worry about the next one. Okay. Right. Let's just go to NZD. Sorry. Right. NZD JPY. Go to the daily. Where was this? Because you're probably looking for a buy on this one. Because I looked at this a couple of times, so I'm a bit worried about it. That's a good point, Henry. Make sure there's enough margin for this afternoon. No good being you got no money to go into this afternoon. Trouble is, Tombi, that's the tragedy of life. You learn more when you lose than you do when you win. That's the tragedy, isn't it? Yeah. Gerard, to 87.35. Yeah, I thought it'd be a long. Yeah, you're getting the idea, this Gerard. You're getting the bloody idea. Yeah. Okay. Right. I'm just a little bit scared of this. I'll be honest with you. That's just me. I am human. I'm sorry to say, like all of you, I'm just a little bit scared. So I try and understand that. So my advice is a little bit of emotion coming in here. I'm worried about the NZ being that bloody great. They had interest rate decision this morning and I had a go at it, but it was exactly the same as expected. It wasn't higher or lower. It came out as no interest rate increase. Can't remember the exact figures of 0.5%. I think what's the interest rate about 5%? I can't remember anyway. The bottom line is they did not. They came as expected. I don't think they had an interest rate increase. Let's make sure I've got the facts right. Give me a second. Go to the economic calendar. Get this little thing out of the way. This out of the way so we see what's going on. Give me a moment, guys. There's no rush on this trade, so I can give you a couple of seconds. Interest rate. Yeah, 550 was before, 550 was the expected, 550 the actual. So no movement on that. Okay. Now, As mentioned, I'm at the moment, this can change. Aussie and New Zealand dollar a year or so ago was one of the two of the strongest currencies going. Things could change, but at the moment they're not that great. Okay, and the Japanese yen I've mentioned many times over the last couple of weeks or so, I think is a bit oversold. So are we going to buy the yen on a bounce off the 50-day, which is clearly, technically speaking, not a bad idea. We can all see that. It's in the buy zone. It's above the 100, which is the black line, the 200 and the 50. And it looks like it's coming down this area for a likely bounce back up. 1, 2, 3, 4, 5, 6 days of red. Is likely to be some profit taking here, a short covering bounce as people close their short positions. Remember, you close your short, you buy to exit. So I very like to have a bounce. Is that bounce going to be enough meat on the bones to make it worth a trade idea? Could well be. I'm just a bit nervous of the NZD, but that's purely me. Okay, sorry, I might advise to miss an excellent trade because technically speaking, it's not a bad idea at all. So what I would suggest is this. Let's look at the weekly. It's holding on the weekly times 10 in the buy zone. Let's look at the 4. The 4 is looking for a bit of sellers. The problem is on the 4. Look at these again. It's bounced, but then the sellers came in again. So it's not really ready to go north as yet. Try the hour, not ready to go north as yet. So look at the different ones. You hope you see what I'm talking about. See what the buyers and sellers are doing. The wick start telling the buyers are coming, or on the top of the wick, the sellers are coming in. Not that complicated. I know we're doing fine. It's not that complicated. All you want to see what the buyers and sellers are doing. You can see some buyers are coming in. So if it does come back to here at this stage, I think wait for a decent confirmation because it doesn't seem to be happening too much in the 4 and the 4 hours on the sell zone, and on the hourly, not a lot is happening. So although I totally see what you're, and I looked at it this morning as a possibility, I'm just nervous of it at the moment. So I want a bit more confirmation to buy the NZD, even though against the end at this stage of the game. That's my take. Any comments on that? I know it's a bit of a mouthful, but I need to try and get it to people to understand what I'm on about, because I often get answers or questions back, clearly meaning that I didn't understand what I was talking about. So I'm trying to lay it on a bit thick, so we're getting the idea. Okay. So it's 5.5, yep, stayed the same. So that's my take. I do like it, but whatever the case is, I think it might be an idea to wait for a little bit more, maybe at least an hour candle for confirmation before we get too cute about buying it. What do you think? Is your idea, Gerard? What do you think? What experience, guys? What do you think, guys?
Roger, can I give a comment on that?
You must indeed, Mr. Olivier. Sure.
Yes. Because of my opinion, because of the interest rate that was released this morning, I think there's going to be a lot of sideways movements today and tomorrow. I think from Friday or Monday, the trade might be a better idea after the market has stabilized after interest rate release.
Well, yes, I think it might stabilize. I hear that. But the point is, back as expected. Remember, psychologically, we don't like the unexpected. Now, if that had been an increase or decrease, then we have a big reaction. It's unexpected. But it's expecting nothing, and it got nothing. So I think once that happened, there'll be a little juggling around. Why do you get a bit of juggling around, even though it occurred exactly as expected? Because a lot of guys had straddle trades, as you had there. And big guys with big money had straddle trades. Also, big guys, maybe for their own reason, institutions think there'll be an increase and other guys a decrease. So they'll have pretty big forward pending orders in there with either being drawn, some filled, and some taken out. So you do get quite a bit of noise or whatever happens. Having said that, it's slowed down now, and as expected, it's come in. So the New Zealand dollar is basically what it was yesterday. You know, and there's no big difference on that. So hope I'm making myself clear here. If it had been unexpected, I'd say wait for the dust to settle or whatever it might be the case. But there's no dust to settle if it came out as expected. Does that make sense? You're a married man and your wife usually comes home from work at 6. And she comes home at 6. You're not going to jump up and down. Oh, hey, you're back at 6. This is normal. But if she came back at 5 or 7, then you start reacting a little bit. I'm trying to sort of make you get the sort of idea behind it. Okay. Make sense, Ivan? I expect as well, Gerard. Very, very high probability. That's not even the issue, Gerard. Profit taking, if nothing else. It's the extent of that bounce before we get a trade out. Okay. That's why with people more experience and doing it for a while, might take advantage of it, and they'll be on it and they understand the mass leverage behind it. When we're dealing with such a large percentage of battling on this, even understand leverage or position sizing, we can't start pushing that sort of idea out, if you want to say. Okay, welcome, Kossi. Good thing you have here. Just to recap on that, trading room here is number one, obviously about looking for new trading ideas. That takes precedence. Somebody comes up with one, we discuss it, etc. When we have a quiet moments between, we often recap trades we all got out, and then we can spend some time on explanation. It's not a trading room where, you know, you can say, I'm not going to buy the SMC product or whatever, because you learned all here. No, you need to know those basics there. And then we get on to sort of the psychology and all the other aspects involved. Because I want to go in some, when we look at the specifications, what contract value means, what leverage means. Because the feedback I'm getting when I'm not in a trading room with these questions, they're going through the classes, they're going through the lessons, but they're not understanding what I call these bullet points. It's no good reading all up about the different algorithms on a MACD or a Bollinger Band if you don't understand the margin, leverage, economic calendar, and those basic bullet points. The contract size on the gold's the same as Dow, but different to silver or different to whatever. These things I don't think are fully understood out there, but they are vital that they are, because this is coming back and biting. Anybody who's been trained for a while will know it's tough enough dealing with the emotional ups and down noise of the markets without having to deal with stuff that you can control. What the NZD JPY 18650 goes from here, up or down, nobody knows. I don't know, nobody knows. We take an overall view. That's uncontrollable. But I do know that if I go in with a certain balance and I put in a 50% risk exposed, you know, the base like that, we can do something about and control. I'm just going to mute you all now. Some guys are unmuted despite my request. And so it's sort of interfering with the sound, so I can't hear. Because these stuff got to be understood. And I pray I'm on my knees if you don't, please. I mean, Nikki, I'm going to try and explain this again to you. It's very important because you interact. It's very valuable having you. But if you don't understand something, going asking somebody else is not going to work. They'll say the same thing. And if it leads on to trying to explain anything to do with advice, they have to pass it back to me anyway. So it's very important. Maybe I speak too quickly. I'll try and slow it down or whatever. But it's very, very important that you are on the same page. If you're not, don't say, I don't want to ask, I'll go somewhere else, because some of these guys don't know either. It's got to be understood. So NZD, JPY, wait on a minute. If you want to look at a trade, absolutely, because I experienced guys here who know what I'm about to say, and I don't want to frustrate them. I try to make most people in here happy, but it is coming back and biting by people who are not knowing the basics and they've been trained for a while, and it's smacking them hard. And you know, we can clear them up. I hope we're all good on that. We kept that. Remember, I just said that takes precedent before going further. AUDJPY. You want to short it. I'm still nervous of yen. Is the yen, it's strengthened quite a bit if you look at those 6 candles. Has it strengthened enough to continue to be strengthened, the AUD coming down? I personally am a little bit nervous, to be honest. If that had been the CHF or the Canadian, the dollar's a bit iffy at the moment with all this interest rate talks. The dollar, I'm very wary at the moment. But the moment, I don't know. It could cut further down. It seems to be the momentum is. But at 1, 2, 3, 6 days of red candles, there might be some profit taking. There could be a bounce before it comes off again, or it can even turn around. I'm a bit iffy on this. I'm 50-50 on it, to be honest. That's my impression. I want to be 65 or better before it goes out. If I'm wrong, it happens. I've got 35% probably I might be wrong, but I want a 35 probability wrong, 65 right. At the moment, I'm 50-50 on it. And if you like 50-50 odds, then why do this? Why not take your money and go to the casino? Actually, not 50-50, they're slightly less because they have the odds slightly on their side, but you get my point. It could be a bouncer along. I think like the previous one, NZD JPY, I tend to see there could be a bounce for a long, yeah. But there's a good point. Pietro's got some idea what's going on, so has Gerard. And if you get two people knowing what's going on and totally opposing likelihoods, that to me is stay away. I do that in the strategy rooms in the morning where we have in that office. If I think that's a buy and somebody else thinks a sell, no, we like to have it all on the same side. We all agree it's a buy or a sell. If it's one half saying, yeah, well, hang on a minute, we want to have, you get my point anyway. So two experienced people, the ones of my own self, and I'm on that. I think a good reason for a buy here, actually, but I could also see a likelihood it could further come down. So rather stay away. Okay, LIA. Yeah, and you see how similar they are, the ADNZD on the JPY, most of them, similar setups, yeah. Similar cultures, similar currencies. Okay, how's our CHF JPY doing? Baffing around, but it's okay. So hopefully it'll come right. Brent, any movement down on this one? Faffing around, it will come right. Sorry about Oxy, it went. I still say the information had at hand seemed to be the right way of the name of the game. What's this thing doing now? That's better. That looked like rubbish to me. Always go 4 hours back today. You get data coming through to make sure it's right. I still say that the trade was right. We shorted it down here. It was in the sell zone, right against support. It came off a bit. I think it was here when we got in. And I thought, we've got a bit. We bounced up there. The hell came down. That was the idea then. We didn't know this was going to happen. And I still say that the trade idea was correct. The market didn't agree, and that's why we got stopped out. And that's what a stop is for. Okay, you put the stop at 60. Oh, it must come off. I'll move my stop to 60.50. Now you increase your loss. Will it come off from here? We shall see, but we'll leave it for the moment. Okay, but we can't anyway. Remember, it only opens up after 3 anyway. But yeah, so it happens. That's why it's annoying. But that's all it is, because you learn in the trading to get your volumes right. If you gave you sleepless nights or you get about to jump out the window and get you're overexposed with money you couldn't afford to lose. That is driving too fast when you can't afford a parking ticket. Not a good idea. I think the Brent might come right. I don't know. I mean, I think it will. Of course, I think it is. I've got a trade in. You've got a good trade in. You've got a trade signal out. We've got the strategy, let it run. We've got the stop protecting in case it doesn't. Okay. But we're all good with it. Now, I want to explain, Nicky, I want to make sure, I hope you're here. It came up with you not fully understanding. It's so important, not just you, everybody. Great you're here, Nicky. Good stuff. I think a little bit of a weakening of the dollar price. Remember, most countries are on US dollars, but oil is. So if you get a weakening of the dollar price, it makes oil cheaper to buy it. Get it? Oil's in dollars. That's why it's inversely what you call it? It's inversely correct. It correlates with the dollar, but it's inversely proportional, like gold. And if that sounds all fancy, it's quite simple. You're paying 20 rand a litre in South Africa because you're importing oil, which is measured in dollars. The dollar rand exchange goes from 20 to 10. Bit of an exaggeration. And the oil prices stayed the same in dollars, but you're getting a much, much better exchange rate. So therefore, now you can buy your oil at 10, so you're going to use more fuel. What BRICS issue are we talking about now? Because I'm a bit wary, getting too cute about the BRICS lately. We've got the second most powerful, biggest economy in the world, as in China, and the fourth, as in India, in there. And then, don't be nasty, but you've got a couple of freebies in there, South Africa being #1. They're not even that level. And they're making a right mess of things, as we all know. picking on it, but that's the way it is. The leaders are not doing a good job, whether you like them or not. It's fact. Okay, anyway, they might be nice guys, but that's the fact. Russia is a gangster-ridden place. Clever people, don't get me wrong, but gangster-ridden that manufacture nothing, but they've got natural resources. Brazil is a bit iffy at the moment. It's got potential, but it's a bit iffy. So I'd be a bit wary of that. It's a lot of media song and dance, we'll see anyway. I've been talking about that currency for a while, we'll see. If the currency comes in, Russia for its natural reserves, I like them. India and China, fine. Brazil, maybe. I don't know what they need South Africa for. Might be political correctness, but that's about it. But I don't know what they need for. Don't worry about it, basically. Nixon took it off the gold stand. I might talk about bringing that back. So I still think the love of government for popular vote rising, bringing more money to implement social freebies, for want of a better word, they need to print more money to pay for them because they haven't got the money. So I doubt they can bring back the gold standard anytime soon. Do you know what I'm talking about? Don't worry about it. Leave it alone. Sorry, it's not being cynical. It's sort of virtual way it is. Anyway, we'll move on from there. You know what I mean? You're in the housing business. You know, you reach a £1 million house and £1 million £1 shares. You want more shares, you need another 1 million shares. Trouble with that is now you've got 2 million shares out of the £1 million house. The house price is still £1 million, but the value of the currency has dropped by 50%. That's what they do. They prey on economic ignorance to play people out there. It's bloody disgusting, as somebody once said, and I totally agree. Can't devalue gold. You devalue the currency. Can't devalue gold. Gold maintains the value. That's why it's near dot. It's been the backbone of the world's currencies. Now the backbone is the politicians playing democracy games to get votes. Anyway, it's another story. Okay. Yeah. Okay. So we got the trades out. Let them run. See what happens, and just hope they come right. Okay. Some of the others are pretty good. The NZD CHF in the end it's TP. NZD CFD. Where is it now? CAD, sorry. NZD CAD, is that the one that came up? Yeah, I think it was. It seems to be coming right. It's hovering a bit. It broke the 82, and it popped up again, but it seems to be doing okay. Bit slow, but at least it's in profit. You just have to hang 5 on the others. Okay, right. Now, Nikki, I think you're still there. Make sure you are, because I need you to help me on this one, because these stuff I want to spend some time on. Yes, you are. Please, if you, Nikki, I'll unmute so you can interrupt if you're not sure, because you need to get this through. Because I'm pretty sure if you're not understanding, other people aren't either. I want to discuss leverage and contract size and things like that. I'm very sorry, Anna Marie, Gerard, Pietro, Chris, Farney. You know this. I know you do. Please, unless you come to trade, please interrupt. I'll go on to that immediately. But it's worrying me so many people, by far majority of trading, without knowing that they're driving in a car and the speed they're doing and all sorts of things like that. Okay, good, back to basics. Okay, now let's just start off with a trade idea. As I said before, many companies don't do this. The idea is to say, that's a trade idea, it's not a guarantee, nothing like that. We're suggesting it looks like a buy. Most companies say buy at that. So they didn't give the TP a stop loss. You'd SL and TP the other way around, doesn't really matter. And they say often or better. So in other words, the signal goes out at 9 o'clock, you get to your computer at 10 o'clock, and the price is 158.90. Well, that's obviously a better price. What a pleasure. If it's now 159.20, you might think that ship is not worth chasing. It's gone too far. The TP will still be the same. This will be the same, but the risk will obviously change because it's a higher price. The risk will increase and the reward will decrease. If it's a lower price, obviously the risk will decrease and the reward will increase. That's fairly straightforward. Hopefully it is, and fairly obvious. So if you miss the trade, you can quickly go to the calculator. There is the position size calculator and put it in. If you haven't got it, clearly, then you go to the live chat, tech support, have it download onto your computer. Straightforward, we know that. Right. Okay. Now, most companies don't do that. And if they do, they'll put this in because they assume if you're in the derivatives market, you've got enough mathematical nous to learn to extrapolate for your balance to a risk per micro. But we even go the next step and put it up to 4. So in other words, that's a risk. So if you've got 1,300 Rand in your account, 10% is your risk. So if you don't want to be putting in this guy, you might not have enough margin anyway, because then obviously 500 Rand is a percentage of 1,300 Rand is nearly 50%. So clearly a bit of understanding should come in. So work on percentages. Now, start off with a simple percentage. If you got, say, 3 grand or 2.5 grand, plus, minus, or less, make it 2.5 grand less, work about 10%, maybe up to 3 grand. But once you go over, you get a 4 grand, reduce your percentage risk till you get to about 5 grand, then you go about 5-6% risk of your. So what 5% of 5 grand? About 250, maybe 6%, maybe 300 Rand. Work on percentages. That's something that you do before you get matric. I'm not here to teach you reading, writing, arithmetic. We assume you know that. If you don't, you cannot do the derivatives market. In fact, it's like not having an internet or a computer. You're going to battle to death. It's one of those things. Right, now you get a 10 grand. I'm suggesting you bring down your risk down to about 5%, something like that. It's up to you. Once you go above 25, maybe 3%, 2%. Once you go about 50, maybe 2%. That's up to you. Just remember that. In other words, you can reduce your percentage risk because you've got more Tom. And the beauty of having more Tom, you can diversify. The problem is a guy comes in, he puts in a couple of 100,000 Rand, and he doesn't understand that. He ends up overexposing, comes back and bites. And that's where the problem is. Keep your volumes within that area of the risk. So you now got 5 grand in your account. You're better with 300 Rand. That's 390 is too high, 130 is too low. So you're going to go 260. You say to yourself, can I afford 260? Yes, I can. If I can afford to lose 260, I'm not going to have a sleepless night if I get stopped out. You get the idea. So that's why I look at it. If you go in at 158.80, well, clearly it's about 100. I don't know off the top of my head, probably about 100 Rand. So you get, it's even better. I can't seem to find more than that. You've got to understand that. Look at the damn thing and do the basic arithmetic. We're not here to teach you basic arithmetic. If you don't do that, you need to go and get a course on arithmetic, not maths, arithmetic, because you cannot cope in life if you can't do that. Certainly won't be able to do it in the derivatives market. That is absolute. Now, this is the next part we go to. Right, if you go to f-stop, this is a share, CFD. You left click, you right click, and you go to specification. If you're not sure after this, we'll do question answers because you've got to get this. If you still don't get it, you ask around, still don't get it, you cannot trade. If you can't change gear and you've done 100 lessons, you still can't change your gear, you still can't, then driving might not be for you. Maybe you have to get a bus, I don't know. Right, you look at this, you right click and you look at a couple of things on there. Contract size is 1. So that means when you buy 1.0, standard 1.0, you get 0.1, 0.01, and 1. 1.0 means like 1 share. Right, 1 share. What's the exposure on 1 share? Let's not. Give me a second. It's $15 US a share. You multiply, make it 20 to make my life easier. 20 to 1 exchange rate. 20 times 15 is 300 Rand. Is that right? Yeah, 300 Rand. Okay, so it's 300 Rand is the exposure. So clearly, if you go in on the one standard lot, I'm looking at the screen now, not the chat, I'll come back in a minute. So I'm trying to find words to get this basics through. Contract size is 1. So you go 1.0, your exposure, not your deposit. When you buy a million rand house, you buy a car, that's the cash price. You put a deposit out. So the margin deposit is saying the contract size, the cost of 1.0 is 30 Rand. So clearly you're not going to go 0.01. That's ridiculous. That's when you go 50, 100, or 20, or 10, depending. That's why on the signal I even spell that out. Now we'll leave this and we'll go to gold. Nikki came up quite a good point on that one. Gold. Now, I want to show you something here to try and get this understood. The contract size on gold is 10. The deposit, depending on what leverage account you got, is that amount. If you want to know what your leverage is, you divide that into 100. So 0.009 is at closest, damn it, to 1%. That's 1% deposit. So if you want to buy a R1 million house, a 1% deposit means 10,000 Rand is the deposit. It means you owe, the balance is 990,000 Rand, which you pay swap fees or interest on. Okay, but even though you've got 20,000 Rand, if you've got a 10,000 Rand deposit and you put in a big position on that 10 grand, okay, but you're responsible, your exposure is a R1 million house. That R1 million house, just on the ups and downs of the movement, comes off by 1%. 1% of a million, not 10 grand, 1% of a million is 10,000 Rand. So therefore, your 10 grand account would be wiped out. You probably margin called before it. So you've got to understand, even though only that amount came out of my account, you're responsible for the exposure, the car, the house, or whatever you're buying, if you get the point. Okay. Now, this says 10 contract size. Well, if on F-stop I showed it $15 for one, that means clearly if it says 10, and that says, let's go back to gold now, sorry. Gold now says 1933. That's not 15, that's 1,000, call it 2,000, a slight difference in number to 15. And it's not 1, it's 10. So it's 10 times, ignore the cents, by the way, it's 10 times this figure. With 10, that's $2,000. 1.0 now is not a $15 exposure, it's 10 times 2,000 or $20,000 exposure. So 1.0 means you're buying a 20,000 US dollar house. 1.0 on F-stop means you're buying a $15 house. Get it? Right. Now we go to the Dow. Right. You look at the contract size. This is not the market, it's a normal one. This says 10. You get it? The margin I've explained. 10. There you are, contract 10. So if you go 1.0 on this one, it's 10 times 34,000. Call it 34, you know, get the number to it now. $34,000. Your now 1.0 purchase is $340,000. Now, 1.0 exposure on Dow is $340,000. On Ford, it's $15 at 1.0. Are we getting the idea? I want to give another example. Gerard's is a very rich guy, and he's going to buy a house in Malibu, right on the beach, a mansion, and it's $100 million. Okay? And Joe Soap there isn't so rich. He buys a house in South Africa for 1 million Rand. Call that 100, what's that, about, what's 100 times divided by 20 is what? $50,000. Right. So Joe Soaps bought a $50,000 house and Gerard's bought a $100 million house. What have they got in common? Well, they both bought one standard lot of one house. But there's a slight difference, $100 million and $50,000. You get the point. So when you buy 1.0 here, that's $340,000. If you buy 1.0 here on this is what the Disney, that's 80, call it $90. That's a $90 one exposure. This is $340,000. That's what it means. That's why is gold 10 and the other 10? I totally agree with that. A lot of brokers have the contract size and gold's 100 to take that situation out of it. But for whatever reason, we've stuck with the 10. I mentioned a few times, they shrunk the shoulder. Never mind. It's the way it is. It's not a big problem. In fact, none of it's a big problem until you don't understand it. It's not a problem with driving 120 if you know you're doing it. If you think you're driving at 60 and you're doing 120, it's a different ballgame. Do you understand that? It's very, 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 very important. So look at the contract size, multiply it by what the figure is up there, and that will give you one standard lot in dollars. You multiply by the exchange rate into rands, and that's why you shouldn't have 0.01 on all of them, because one size doesn't fit all. Have we all got that idea? I don't know. Past that, nobody seems to bloody know, so ignore it.
Roger?
Yeah.
So
Perfect.
just to So can you just put up a Forex one quickly? I just want to make sure I
Oh,
understand.
very good. Great stuff. Thank you. I'm going to do that next. I don't know. I've asked you if you don't know, Anne-Marie, and it's not interfered my training for years and years and years. So sorry, Matt, can't help you. But it's not made a difference in my life. So I think probably more stuff to worry about than that, to answer your question. Let's put one up. Let's put this one up. Doesn't really matter. All of them are the same. This is something I want to explain. All of them are the same. What's the contract size? Is it 1? Is it 10? Is it 100? Is it 500? No, it's 100,000. What does that mean? That is 100,000. Sorry, get the ready one up. The base currency is the pound, the secondary currency, NZD. We buy or sell the base currency. Okay, so clearly it's 100,000 pounds. Okay, so 1.0 or contract size here is 100,000 pounds. If you go the Aussie dollar against the US dollar or whatever it is, then it's 100,000 Aussie dollars, 100,000 US dollars, 100,000 whatever it happens to be, 100,000 times the base currency. Are we good? So that figure is very different. Remember F-stock, $15 share, contract is 1. So your exposure of 1.0 is $15. If you go 1.0 on this one, your exposure is 100,000 pounds or roughly 2 million rand. Slightly difference to 300 rand and 2 million rand. Now you're getting what I'm talking about, where you need to understand what the contract size is. I'm going to buy, sorry, Nick, I pick on you. I'm going to buy 10 Nickies. That contract size is 10. Or I'm going to buy 1 Nikkei. That contract size is 1. You get the idea. 10 cars or 1 car, it's the contract size. If you go to silver, it's 500 to 1. But why is it 500 to 1? Because the silver price is only about $20 odd. If you go to NGAS, it's 1,000 contract size, but the price of net gas is only $2. It's not $34,000. You get the idea. So you can't say I bought one what? Well, I bought 1 box of matches and 1 Rolls Royce. What have they got in common? 1, yes, with a slight difference in size to 1 Rolls Royce and a box of matches. Are we getting the concept now?
So just to make sure, you took any contract size, you multiplied by the sell price but you ignore obviously the cents, the 0 points, the whatever, and then that would give you your 1 standard lot size.
1 standard lot, that's right. It's 100th, well, you don't have to multiply this in this case to confuse them out. That's just the exchange rate. That's the exchange rate. Ignore that. Sorry, I get your point now. That's the exchange rate. No, you just multiply this figure here by, and this, sorry, quite right, good point. In Forex, the contract size is 100,000, all 100,000, by the way, make life a little bit easier for you. And it's multiplied by 100,000 by the base currency. So we get, let's say we're trading the Zim, let's say it's a Zim dollar against the, we don't have it here, but let's say it's a Zim dollar against the South African rand, right? If the Zim dollar is the base currency, and then we had 100,000 standard, it'd be 100,000 Zim dollars. So you clearly, because the Zim dollar, I know what the currency is, you probably go, if you go in on a, you've got a 5,000 rand account, you might buy 2,000 lots. Because 100,000 Zim dollars is squat. But if you got 100,000 pounds for 1.0, it's a different ballgame. You get it? If you're still not sure, try something else here. Let's go back to the NAS. Where's the NAS here? Right. This is the normal one. What is the contract size? 10. All right, 10. So if you go 1.0 in US dollars, the contract exposure you're buying, the house you're buying, the car you're buying, I'm talking about your deposit. You're buying a 200 grand motor car, never mind you're putting a 10 grand, 30 grand, 50 grand deposit. So what you're buying is a 200 grand motor car. That's your responsibility. Whether the bank lends you 80, 90, 100% is irrelevant. The point is you're buying the car, that's your exposure, that's your responsibility. The bank's in the lending business, not the car buying business. So you've got to be responsible for that car. And they're not lending you the money. They're not giving you the money. They're lending it to you. They expect it back. So that's why you've got to be careful. Right. Contract size is 10. So 1.0, when you're buying this motor car house or contract or whatever you want to call it, is going to be, call that $150,000. You get it? You put a deposit down, but your exposure, your purchase, or whatever you want to call it, is $150,000. Okay. If you go and buy a cheaper version, that's house A, this is house B. This house B, contract size only 1, not 10-1. So 1.0 exposure is $15,000, not an 150. So if you get, let's say, a tenth of a car like one Mini, your exposure, not your deposit exposure, you take the decimal point off. Instead of being 15,000, it's 1,500. If you go 0.01, now there's a micro, then it's $150. You put a deposit down on that. I'm glad it's coming up. You guys are asking questions. It's clear this has not been understood. I thought it was. That's why I'm trying to use a house or something to make it more familiar territory. It's the same principle. Where are we? Dollar yen. Right. This is a currency. So if you go 1.0, it's $100,000 your exposure. Exposure means the price of the house. You know, you buy a 200 grand motor car, you put 20 grand deposit down, you're still responsible for the house. You're not responsible for 20 grand. You know, you're responsible for 200,000 rand. That's what you bought the car for. That's your exposure. 1.0 is $100,000 exposure. Clearly, that's not your deposit. That's why you go 0.1, for instance, and you got a highly leveraged account, which means your deposit is minute. You've just got to understand your exposure. Never mind your deposit exposure, and it's $34,000. If you do the normal Dow, it would be exposure 0.1. Okay, because it's 10-to-1 contract. 0.1 is a tenth of that. So 0.1 is going to be, instead of 304, it would be $34,000 exposure. Get that into rands. 34,000 times 10 is 340. It's about 600,000 rand, maybe slightly more exposure. All right, you've got a high leverage account. Only maybe a couple of grand came out. But that 600,000 rand doesn't have to move much to knock you into margin calling territory. So you've got to understand this concept. And don't start going asking other people there, because I'm not sure they understand, and they will just give you the same answer anyway. Asking somebody else won't give you a different answer. You've got to understand the basic arithmetic behind this. Percentages. Okay, so this is going to be all going to be 100,000 rand. In this case, it's $100,000, not 100,000 times 139. Forget that. That's the exchange rate. In this case, commodities, the index shares, 100,000 times the price of the index, the commodity or the share. In Forex, it's 100,000 times of the currency. So this 1.0 is $100,000. So every time it goes up 1 pip. What's 1 pip? Not this little figure, that's the point. This is a pip. Okay, 60 to 61, that's $10. You go to 62, it's $20. You get the idea. So I'm going in now 1.0 at 139.60. It jumps up 5 pips, like that, like that, like that. That's $50 US, $10 a pip. $1 a pip per 0.1, 10 US cents per 0.01. Then you multiply the exchange rate. So now you've got 50 grand in your account, you've got a high leverage account, and then you can afford to go in 2 standard lots. You're forgetting 20 pip movement, which is not that big, guys, eh? 20 pips is $400. What's that in rands? 8,000 rand. 20 pip moves 8,000 rand. 8,000 rands, the last percentage of 50 grand. You get the idea. These have got to be understood. We even do it for you by giving the risk per micro, and we expect you to be able to at least do the math to extrapolate. If you don't say, why do you 0.04, we got 15 grand, you can afford 0.08. We only said 0.04 in the signal. Well, surely you can, if it says 300 for 0.04 and you go 600, you go 0.08. You get it. And it is this mathematical lack of understanding, maybe not explaining well. I'll try and explain it again, because you will not trade successfully. You get this point. It is difficult enough to understand the vagaries, the machination, the bloody price action. But if you can't get the maths, you're going to go in under overexposed and it's going to come back. You get a lucky day, a bad day. You've got to understand this. Then you get on the proper level. Are we getting there? Because I'll spend the rest of the bloody day doing this, because you cannot trade unless you get this concept. What is margin? Margin is deposit. What's leverage? Dividing the margin or deposit to 100. If it's £1 million house, 100,000 rand deposit, 100 grand into a million is 10. Leverage 10 to 1. Simple as that. Okay. Divide, so 10,000 rand deposit, 10 to a million is 1%. If it's 2,000 rand deposit, 2 into 2,000 million is 500 to 1. You get the idea. Are we all clear on leverage, contract size, anything else? Because no, sir, I'm a bit shy to ask, go and ask somebody else, because they'll give you the same answer. Let's clear it up here.
Roger.
If you're asking on an email or a chat line, if you can't understand on the Zoom, you're going to battle understand at all. Please, Nikki, go for it.
Okay, so I'm going to ask you just to repeat this, the Forex one. So I understand the indices and the commodity one.
Sorry
but-
to interrupt, Nikki. I'm sorry to interrupt. I just want to clarify, Petra. No, on the currencies, that's just the exchange rate. On the currencies, if it's the NZD USD, it's 100,000 NZD, 100,000 US dollars. If it's the pound NZD, it's 100,000 pounds, one standard lot. The exchange rate is nothing to do with it. You only multiply it by the figure up here if you've got commodities or if you've got an index or you've got a share. If it's a Forex or currency, it's 100,000 times the base currency. So in this case, $100,000. If that was a GBP, 100,000 pounds, it'd be 100,000 NZD or 100,000 Aussie dollars or whatever it is. Or Swiss franc, 100,000 Swiss francs, or whatever the base currency is. Oh, that's clear. Sorry about that, Nikki. Go for it.
Oh, okay. So based on what you said, then do you ignore the sell and the buy price, and then you just take the actual currency of the base currency times it by the contract size?
Okay, that's a good point there. The difference price here is the spread. Okay.
Right.
If you're going to go into a currency and you want to go and buy 1.0, remember a micro is 0.01, 0.1 is a mini, 1 is a standard lot. You won't be able to go in on 2 grand anyway if you want to do, because you don't have enough deposit. Like this, like Gerhard, sorry, Gerhard, your $100 million mansion, even if it's 1,000 to 1 a leverage with a very small deposit, even 1,000 to 1, you won't have enough deposit to get in, so you'll get in anyway. You don't have enough deposit, you don't have margin. I want to buy this 200 grand house and it's a 10% deposit. If you don't have 200,000 rand, you can't buy it anyway. I've got enough margin. Anyway, going back to this one. Yeah, the spread is purely the brokerage. That's why when you go in, if you buy right now, US dollar yen, you'll see spread coming up on your profit loss because you get in at this price to get out of that. Why do you, every time you enter a trade on the Forex, it always seems to go against you? No, because you buy this, you get out of that. That's called the market maker spread. The more money you have, the bigger the broker, the more liquid the broker, the bigger the broker's book, the tighter the spread. It's like anything else. You buy one shirt from a shirt company, you'll get a different price to a guy who buys 100,000 shirts a month from them. It's economy of scale. Hopefully that can be common sensely understood. You get my point. So if I go in now with one standard lot, right this instant, I'm going to be down $70 US because the spread there is 7. So I'm only when that gets to that, if I'm going long, will I break even. If I go short, I'm down $70 US on a standard lot, 7 on a mini or 70 cents on a micro, whatever that is in rand, until this falls to that to break even. That's why you see the red. So when you go into a Forex, the spread is just a brokerage. What you need to concentrate is 100,000 is the standard exposure of one standard lot in US dollars. Let's find another one. This one here. This is 100,000 New Zealand dollars. That's in other words, that is a different exchange rate to American dollars, you can see. So a 1.0 exposure is slightly less, or quite a bit less. It's 60% of the exposure of the US dollar CAD. Because if that's 1 on that and the exchange rate is 0.6 of 1, it means 60% of $100,000 is the actual exposure, because the New Zealand dollar has a smaller value, and you're getting 100,000 New Zealand dollars instead of 100,000 US dollars. That's what I have an exchange rate for. $100,000 is very different to 100,000 yen, clearly, or 100,000 rand, or 100,000 pounds. Same principle. Are you getting that, Vicky? If not, we'll keep going till you do, because I'm pretty sure the others are battling as well, and they've got to get this. Otherwise, it will trump you, and there's no need to trump you, because it's not that bad, and it can be understood. We're not going to go and solving the equations of the world on this, but it can be done. Right, Nikki, are we with it? If not, please reiterate till you do get it.
Roger, so you know when you said you take the contract size times the base currency, right? And then you times by the exchange rates. So with the exchange rates, are you using exchange rates, the NZD, USD, the exchange rate between those two pairs?
No, we're not using the exchange rate at all. We're just using 100. Let's say you're going to buy 62, pretend it to stay at 62. Okay, we're going to go in one standard lot, not a mini, not a micro. One standard lot. What we do is we check here. I can check it for. I'll tell you right, it's 100,000. All comes 100,000. 100,000 means don't multiply by this figure. That means one standard lot exposure is 100,000 New Zealand dollars. Okay, 100,000 New Zealand dollars. Now, if you go into this one here, that says 100,000. 100,000 what? 100,000 US dollars. That's the base currency. Now, is $100,000 exactly the same value as 100,000 New Zealand dollars? Clearly not, because $1 has a higher value than New Zealand dollar. So in other words, I'm going to tell you right now, I'm going to give you 100,000 yen, or I'm going to give you 100,000 pounds. Which would you prefer me to give you? What would you prefer me to give you, Nikki? 100,000 yen or $100,000? I'm going to give you a nice little gift. What would you prefer me to give
Dollars.
you? Clearly.
It's a higher. Yeah.
They get it. Exactly. So this means when you go 1.0, your exposure contract value is $100,000. If you go in the NZD USD, it's 100,000 New Zealand dollars. You get it. Okay. When you go for a share, forget the exchange rate. You just multiply the share by what is the contract value? 1. All shares are 1. So the exposure on this is 1 times, ignore the cents, 114, call it $115. You put 1.0 in Oracle, you're exposed $115. Your deposit on all of them are 5%. What's 500? It's 20 to 1 leverage. So you buy, let's pretend the share is $100. Make the mathematics easier. You buy 1.0 as your volume, exposure $100, your deposit is $5. Simple as that. Okay. Are we getting anywhere? Our pitch has been funny with me, rather 100,000 yen. All right, fair enough, mate. He's teasing me. Cheers, Marcus, no problem. Are we good to this? Because if we're not, guys, we got to be good. If you continue trading and you can't get this basic mathematics, try and try again. And if after 100 lessons you're still not getting it, you might have to question is trading going to be for you, because you're trying to drive a car and never mind studying all the details under the bonnet. If you're still not sure how to change gear, or still not sure how this brake thing works, or steering wheel works, you have to have that. You get my point. Okay, Nick, keep going, because you're a good spokesman for a lot of people out there. I'm glad you're coming up with this, because that's why I'm spending time on it. I said to Clinton, spend time on it, because people are asking, going on the chat line and all the other live chats. They can't get an explanation here. They won't get in a live chat. They will give you the same answer anyway. And I shouldn't be saying this, but someone, I'm not sure them, know themselves either. And often they shove it back to me. Might be I'm not explaining it right, or too quickly. I'm trying to slow it down, etc. But I'm trying to use analogies for you to get the principle. Okay. That's correct. Mike, well, if it's $100,000 and a micro, what's a micro? You move the decimal point 2 points, right? So 1.0 is the same as 100 micros. Simple as that. So there's 100 micros to a standard, 10 minis to a standard, or 10 micros to a mini. It's purely decimal point. 10 pounds, 1 pound, or let's make it rands. 100 rand, 10 rand, 1 rand. you get the idea. 1 rand's 100 rand, scary shit, they say. So if it's 100,000 rand for a standard lot, then a mini lot will be 10,000 exposure, and a micro will be a 1,000. Okay, just lop a couple of noughts off. 100,000, 10,000, 1,000. Exactly. That's your exposure. Then you put your deposit down. Okay.
Roger,
Go for it,
Roger?
please. Yeah.
can you maybe just use the South African rand against the dollar for this explanation of the contract size? I think maybe all of us will maybe get it a bit better in that respect.
Not a bad idea, my friend. Thank you. Make it more familiar territory. That's why I tried an explanation. That's why I say man meets girl, buying a house for a car, relationship, things like that. Trying to put it in a familiar comfort zone context. Because it's the same sort of principle. It's a business, same thing. Right. Now, a standard lot. What is it, guys? We all know all currencies, standard lot is 100,000 times the base currency. There we are. What's the deposit? It tells you. What's the leverage? Get a calculator, put 100 in and divide it by 0.008 or even multiply it, whatever, you get the same figure. If it says, let's say, I'll do it off the top of my head, it'll be 8 to that. What's 8 into 1,000? It's about, was 100, it'll be about 120. So the leverage on that plus minus about 110, 120 off the top of my head to 1. So even though it's a 501 account, leverage on that was about 120. So you check the deposit. I mean, they might call it a 500 account, but one's got a 1% deposit, one's got a 0.5% deposit, one's got a 4% deposit, depending. You divide that deposit or margin to 100 to give your actual leverage. Okay, that's the leverage. Is the 100 million rand house, 10% deposit, 10 into 100 is 10. You leverage 10 to 1. So 1% is 100 to 1. So 5% is 20 to 1. So 20% deposit, 20 to 100 is 5. 5 to 1 leverage. What the leverage means? Every 1 rand movement in the exposure, which happens to be a house, a car, or whatever it is a 5 or a 10 or 500 or 100 to you. So if it's literally 100 to 1 leverage, means a 1 rand movement in the house price or whatever you're buying is 100 rand to you, for or against. Hence the point I'm trying to get of not overexposing. It goes with you, it's going to 100 times the speed. If you're going against you, it's going 100 times the speed against you. You know, it's nothing wrong with having a Formula One car, but if you have a crash, you're crashing at 300 Ks, you're not an hour, not crashing at 10 Ks an hour if you're on a slow bicycle. Just think of it that way. Right, now, what that means, Pietro and Company, is if you buy 1 standard lot, your exposure 100,000 times what? The ZAR or the dollar? Which is it, guys? Exactly. You're getting it. You're getting it. So it doesn't matter what the rand is or the exchange rate is. 1.0 exposure, it means every time that goes up by 1 pip. Slightly different on this one because it's got too many decimal points to confuse the hell out of you. So you've got to lop a couple off on this one. That's why rather beginners left the dollar rand alone. Higher costs, higher margins, higher complications. Tough enough to get the basics without complicating it further. Leave that for down the line. So we're going to leave that alone. I'm going to go back to the trade we're in. Okay, let's go to CHF-JPY. Right. What's this? What's the contract value? Specification, like I mentioned, 100,000. 100,000 what? Yen or Swiss franc? Please, please, let's speed along. And now we all understand to Swiss franc. So 1 standard lot is 100,000 Swiss francs. What is the price of your house, Pietro? 2 million rand, not 2 million yen, not $2 million, not 2 million bloody Swiss francs, 2 million rand. Right. Now, I'm going to buy it off you. I don't have 2 million rand cash. I've only got, I don't know, 20,000 rand cash. Okay, you say, I'm such a great credit rating. 20,000 to 2 million is what? 100 to 1. So my deposit is 1%. My leverage is 100 to 1. And I'm putting a 20 grand deposit down. But even though I've got 50 grand in my account, I'm handing over to the bank, not to Pietro. He's not interested in that. He just wants to sell his house to me, right? He's getting the cash for it. The bank's the one I owe, not Pietro, the bank. I've given 20 grand. I still owe them the balance, but I'm now responsible for 1 million rand, even though 20 grand's come out of my account. You get the point. So if you go into the Swiss franc now, 1.0, the price of your house, the price of your car, the price of the contract, price, whatever you like to call it, is 100,000 Swiss francs. Ah, what deposit do I put down? Let's have a look here. What is my margin? Aha, 0.003. Well, what's 0.003 of 100,000 francs? Well, all you do then is that goes 100,000 makes that 10. Well, 10,000, 1,300. So I only have to put down 300 sodding francs, or whatever that is in rands, multiply into rands, to get 100,000 rand exposure, house, car, or whatever. But that's fine. That's not a problem. Where the problem comes in is a guy who hasn't done the maths said, "Oh, that's all right. I've got 500 francs. I can afford 300 francs." Goes in one stand lot to Swiss franc. A tiny percentage movement of 300 francs downwards wiped him out. What 300 francs downward movement of 100,000 franc house is 0.3%, which is a tiny movement. Are we on the same page with this? Are we getting this? That's why overseas they start to bring in much lower leverages, because the guys are coming in brand new and not understanding it. They're driving their brand new Lamborghini because they put a small deposit down at 350 k's an hour, not realizing they're driving too fast. I'll make it a 1% movement. Your house moves by 1% from 2 million rand, moves up and down, up and down. House price, everything go up and down. All supply and demand moves up and down. Your house price, your 2 million rand house moves by 1%. Doesn't sound much, 1%, does it? Doesn't sound much. What's 1%? Hey, what's 1% of 2 million rand? Divided by 100, that's 20,000 rand. That's just moved. It could easily move 1%. You've seen the speed of these markets. It could easily move 1% in a few hours. You put 20 grand down on that 2 million rand house, right? And let's just, before it goes on to being 3 million, it hiccups 1% down. Your 20 grand's wiped, your margin called, and you're in the right state. You've got to remember your deposit's got squat to do it. You've got to remember your exposure. And that's where your commissions come from. Oh, your commissions are costly. You go to an estate agent, guys, go to estate agents, they're not taking their commission off the deposit. They're taking the commission off the exposure, the price of the house. You get it? Right. You got somebody you can interact with, and you got a picture on there. You can't get it here. How can you get on the bloody chat? You know? But that picture, it's the same principle. Your exposure when you sell a property is the price of the house. They might put a deposit down. They might be the bank might be lending the money. You don't get your commission off the deposit. You get off the actual price of the house, and they're responsible for that house. They move in, they break the champagne, hey, but they're responsible for that house. The deposit is what they do. But if you put down a time, now you let's say you put a 2,000 rand deposit down, a 1 million rand house. That house, 1 million rand percentage-wise, doesn't move much. 2,000, nothing on 1 million rand, but 2,000 is a lot of money to you because you didn't realize that. So you got 50 grand in your account, and you decide you're going to go in because you've got a highly leveraged account, very small deposit, it's 2 standard lots. You've got to remember on this particular one, the Swiss franc, the base currency, every time it moves one lousy little, tiny little 1 pip, not the 7 here, the 8, 1 pip, that's $20. That's what's $20 times, that's about, call it 20 to 1, it's about 380 rand, 380 rand. Let's have a look at the Swiss franc. We're on the Swiss franc now. We're on the Swiss franc now. Let's go to a 15, let's make it an hour chart. The Swiss franc in this is still work in progress, go up here. The Swiss franc in 1 hour moved 45 pips. 45 pips times 20 is 900 American dollars. What's 900 American dollars? That's $1,000. That's about 18,000 rand, 17,000 rand. 17,000 Rand in 1 hour on a 50 grand account. You get in 1 hour. Actually, slightly more than that because it's at the Swiss franc is slightly more expensive than the dollar. But we'll stick to dollars to make the maths easier for myself. So call it just call it, instead of francs to confuse it or pounds or whatever, just call it, let's call it $100,000. So each it's 10 cents American or $1 American or $10 American plus minus per pip movement, depending on a micro or a mini or a standard. Clearly, if you're getting 2 micros, it's 20 cents, or 2 minis, it's $2, or 2 standards, $20 a pip movement. I want to spell that out. In 1 hour, the previous hour, between 9 and 10 o'clock, this particular one moved, was it 43? Call it 40 pips. 40 pips times $20, that's $800. $800, you're talking about 15,000 Rand. 15,000 Rand on a 50 grand account in 1 hour, you're going to be panic stage. Get that volume right. Understand what's behind it. And it worried me. A guy who's got a very large account a couple of months ago asked me, what's the movement per pip level? And I think the guy had been trading with a very large account for quite a long time. I'm talking about over a year. And he asked me that question. I thought, my goodness, what's this thing called gear lead? We've been screaming along in second gear for the last 6 months driving a motor car. Scary shit, man. Are we getting there? Because this is vital. And the more you guys have been trading quite a lot and weren't sure of this, it means 90% are not tender trading, clearly are not. And I'm not sure we're getting the class or whatever, because I don't really go to them, but I'm not sure they're getting this, because this is very important. Hey, Nikki. Hey, Pietro. I'm pretty sure Marnie knows it. Not Marnie, sorry. I mean, Farney knows this, but Gerard almost certainly knows this. But you get my point, Farney and company. I'm sorry to spend so much time on it, because if 99% of the people trading out there of our clients are not understanding this, no wonder they're getting hiccup after hiccup.
Roger, in my experience, sorry, my experience as well, it's actually quite a simple calculation. It's extremely simple, but the more simple it is, the more difficult it is to understand sometimes.
Yeah, because I think we're confusing. Maybe the way I'm explaining it, I don't know. Maybe you can explain it better, or Farney better. Maybe Farney explain Afrikaans. Maybe, I don't know. Anyone understands explaining chords or Zulu, Matabi, I don't care. But it's got to be understood. You cannot drive that car unless you understand that, or you're going to have an accident. No, a pip is, yeah, I've been correct, depending on the position size. If you're going 1 micro, it's 10 cents, right? If you're going 2, it's 20 cents. 1 minute's $1. And clearly, this much, if it's one standard lot, you move the decimal point. You know, you give me 100 Rand, 10 Rand, or 1 Rand, same principle. When dollars are base currency, but it's obviously slightly different. It's the pound, the Canadian, or New Zealand, the base currency. But just to, never mind that, just stick to dollars and then get some idea. So a micro, let's get the position size calculator. That's a micro. So that's going to be 10, it's not going to be 10 10 cents of the Swiss franc. But let's pretend it's $1, okay? So just work on 10 cents. If it's 0.1, it's $1. 1.0, it's $10 per pip movement. That's not this 1 or 7 there. That's a point per pip movement, this thing here. Somebody asked yesterday, you can modify your stop to 30 pips away from market. Didn't know how to do that. Well, if you're going long, then you're not getting that price, you're getting out at this, you're getting out that price. So 30 pips from market would be 30 pips from that price. What's 30 pips from that? Would be what? 158.86. Okay? 158.76. That's 30 pips away. You take that, take 30 off it, you get 158.76, or in this case, 158.75, 30 pips off it. If you're going long, it'll be 30 pips off this price. Not this thing here. Get the third or last decimal point, this thing here you're looking at. That's the pip. If you got that, Ivan and company, got it. Please, Lufthansa, fantastic. Right, you've got to get this. Don't say, oh, yes, and then go and ask somebody else, because they might not know. And if I can't explain it, how can they explain it? You know, and then they've got to take their time from their job to explain it telephonically when we've got a bloody Zoom on here, just because you were shy to ask. So that's why I appreciate having Vicky ask this, because I'm pretty clear now you brought the subject up. That's why I'm spending my time with it. Most people, it's not clear. As clarified in this particular session, it is not clear. And people like Pietro and Ivan that have been trading a little bit, clearly it's not clear. A majority, I'm prepared to bet it's not clear. So thank you. I really thank you when you bring this stuff. Thank you, Nikki, yet again.
Sorry, Roger, I wanted to ask for the PIP one, could you just repeat that with like how you, so do you, which ones do you ignore? I know you ignore the last
Ignore the
number.
point. 10 points, 1 pip. Why do we ignore the point? Because no disrespect, the balances are small. The point only really is relevant when you get a very large balance. The interest rate went up by not 1%, but 0.1% or 1/10 of 1%. Okay, remember one basic point is 0.01%. Okay, or 1/100th of 1%. That's a tiny amount. So we say it's gone up 0.5%, that's 50 basis points. So why are we worried about 50 basis points? What's 0.5%? It's not that much big deal. No, if you've got 1,000 rand. But a 1 basis point, you've got $100 million. These guys, money swishing around the world is in billions, they're mining millions. That 1 basis point counts. You know what I mean? 1,000th of $100 million, a lot of money. 1,000 of 1,000 rand is peanuts. That's why, because our accounts are not that big enough, don't worry about it. It's just irrelevant. It's like saying, I've got to spend, if you buy this, you're going to pay 1 cent a month swap fees. You don't care. What's 1 cent a month? Doesn't mean anything. But if it was, let's say, $10 a month swap fees, that's a different ballgame. So ignore it. So 10 points, 1 pip. When we say what the spread is, let's say it says 50. No, it's not 50 pips. It's 50 points, which is 5 pips. So I put little hand there out of the way. That tiny little figure is the point. The big figure is the pip. So if that's gone up by 10 pips, this will go to 11.3. That's 10 pips. Okay, that's just moved, well, 2 or 3 pips moving all the time. You get the idea. So if that goes from 158.98, yeah, it's just gone 1 pip then. Ignore this one, 1 pip. That's 1 pip movement. Oh, you got it. Not the last one. Let's go to something you might see a little bit clearer. Let's go back to the euro dollar. It's so famously understood one. Everyone knows the euro and the dollar. Okay. What's happened to bloody position size? Oh, it's disappeared. Never mind. Okay, right. Never mind the 5th decimal point. That's the point. We've gone after the pips. 22 to 23 or 21 is 1 pip. So if that goes up from 1022 to 1042, that's 20 pip movement. You with me? Light bulbs going off, brilliant, Ivan. Good stuff. So I want to really put the fear on to get the point. This is a 1 hour chart. From here, 1 hour, 2 or 3, 4, 5, 6 hours. From midnight, for argument's sake, to 6. You're all fast asleep in theory. 6 hours, you're fast asleep. This move down 45 pips. I hope it's going to be a bit more to make it. Let's make it the NAS. Here's a nice one for you. We'll do the not the NAS micro, the NAS normal. Right. This is again a 1 hour chart. Look at this movement in 1 hour. 127 pips. You get it? It says 1277 points. Well, obviously ignore the last 7. It says 127 pips. 1 hour, it's 127 pips. So if you went a standard lot on the NAS, that would be $1,270 in 1 hour. If you were going long and you bought there, at 1 hour, you would have been down, what was that? $1,270. You get it? What's that in rounds? About 25,000 rand. You go one standard lot on the NAS on a 50 grand account, 50% of the entire bounce would have been nailed simply in 1 hour because you're grossly overexposed and you didn't understand, you didn't come to trade room, the difference in volatilities, the different instruments. This is why I encourage people to learn this. The trouble is they come in, they're promised by some guy on Instagram where they get their rubbish from and say, all right, yeah, just do a single, put in 1,000 rand and you'll be nice and retired full-time in a couple of months. Promise you, if it was that easy, I wouldn't be sitting here. We'd have no unemployment. I've been in the Bahamas. In fact, it's ridiculous. And that's just complete lack of thinking and concentrating on this something for nothing. It takes a bit of effort. That's how you would have lost 25k. That's why most people are doing, not because the signal wrong, whatever. They're not getting the concept that they're driving at 350 k's and they thought they're driving at 50 k's an hour. You'll get to Cape Town fast if you ride safely, but if you don't, you've got a problem. I'd rather take my time and drive a little bit slower. I'm under control. I can handle the speed and arrive instead of 6 hours in Cape Town, 12 hours later. I might be a little bit later than my mate who got there safely, because I know when he gets back to Joburg from Cape Town, I'll be a little bit longer getting here, but I'll get safely to Joburg, and he's either kills somebody or he's going to spend the next month in jail with a fine, and he won't be allowed to drive again because he's driving too quickly. And he said, oh, my speedometer didn't work. And the guy told me this Lambo wasn't that fast. That's not an excuse. You know, it's up to you to learn it. Or I never attended classes. That's your fault, not mine. You get the idea. That's why I'm spending some time on this. Yeah, that'll be 25k in your pocket. Yeah, you got lucky. The trouble with that, Gerard, is you got so lucky. You think this is a wonderful business, your first trade, so you do it again. This time you're not so lucky. Yes, I did. Don't tell the lads, yes, the other day, I know 120 speed limit. I got this fancy Lambo and I managed to get to Cape Town from Joburg in 6 hours. And arrived saying, ha, 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 ha. The trouble is, where's Roger? He's not the trading room. Because when he came back from Cape to Joburg, he had a ghastly accident and now he's going to be in hospital for the rest of his bloody life. You get it. Right, Chris, good question. I'm going to work out at 80 rand. There you are, makes life easier. 80 rand a micro. So on a 10 grand account, if you go 0.05, 5 times 80 is 400 rand. That's well within your parameters. I think you probably go 0.06. Even straddle trades on the CPI could work out better. Not always, but a higher probability. Here's a sort of a 65% probability maybe. On there's maybe a 75. You can maybe go a little bit bigger. Maybe you can go 0.07. Risk a little bit more. Even 0.08, as long as you can handle it if it goes wrong. 80 times 7 is 56. 8, if you go 8 micros, what's 8? 64. If you go 8 micros, it's 640 risk. If it goes wrong, can you handle it? If you can, do it. If you can't, well, go back to the one you can. 80 rand a micro, can you handle it in your head as well? No more I advise. You've got to handle it in your head. Now I'm going to pick on Gerard again. Gerard just opened an account for 50 grand, but what Gerard hasn't told any of us here is we're waiting for a 5 million rand fixed deposit to be paid out in 2 weeks. So why is Gerard now going in with a massive overexposed risk in 50 grand? Because it doesn't matter to him. He can risk 25 grand because he knows the release of the fixed deposit, 5 million, he's covering it on that. That's a different ball game. But if you're coming in with 5 grand and that's all you've got, and then you've got all your other expenses, and that's a lot of money you save for it, then you've got to watch your exposure very, very carefully. I hope that makes sense. That's why I say, for me personally, the 500-1 leverage should really be applicable for Gerard, because he knows me. Make it Farney, just for bloody change. Farney, is he still there, by the way? There he is. Farney there. Again, he's got a 10 million rand savings deposit. It's going to be, he's already put in the release of it, and it released in 6 days' time. He's got 100 grand cash just sitting in the account, and he wants to start trading. He wants to go in a lot bigger because he knows a 5 million rand's coming in. The problem is he can't go in bigger than he can afford it because the deposit's too high and 100 to 1. So he goes in the 500 account because he can afford the higher exposure with a small deposit until his 5 million rand comes through. Then the 500 rand to 1 account makes an enormous amount of sense. It doesn't make sense for guys who don't know how the pros and cons of leverage, tiny amounts, and they think, oh, well, I want to try and extend my tiny amount of balance by having a lower margin, higher leverage, so I can go in bigger and then wonder why they're getting margin. This has got to be understood.
Roger, sorry, I just want to answer Chris's question there on my personal experience. Chris, I normally use the position size calculator to help me with that as well. 0.1 is very high on a 10K account. I normally use about 0.3. I've got about 15K in my account. So I usually use about 0.3, which is a very high exposure, but it leaves me with about approximately $100, $120 in my account still, give or take.
Okay, let's
Okay,
just
that makes
prove
sense.
this in action. It makes total sense. Let's prove this in action. All right.
Thanks,
Let's put a buy on this. Let's put a buy on this one. Okay. Why are we gonna put the stop down here? Because I bet he will say so. We're gonna put the stop down there. How far is that? I want to get a decent sized stop. I want to even further away. I'm going to put the stop down here. How far is that? There we are. Nice long stop. We'll put the TP up here. Well, I'll put it up here. 84.80. Make it 85 and round figures. It's just an example of faffing around here, trying to get this point through. Right. What is the risk here? It's 177 per micro. If you go for a standard, if you go for a mini or 0.1, clearly you multiply that figure by 10. All you mean is you move the decimal point. This is basic arithmetic. I hope the teacher, that would be rude, teach this at school. If you're not, this should be hung. So if I multiply that by 10, it's going to be 1,770 or 1,772. You get the idea. So if you go 0.1, your risk now is 1,783. Now that's all very fine if you've got a, let's say, a 80 grand account. You've got a 10 grand account. That's close to 70. Well, not close. It's nearly 18% of your entire capital at risk on this trade. If it comes right, well, hallelujah. If it doesn't, 80%. That's 18%. It's a lot of risk. You get 2 or 3 bad ones. Remember, you can get 5 good ones. You might get 3 bad ones on the trot. It happens. Now you lost 6 grand. You just started your trading journey. You just paid all money for a course. Now you're completely, absolutely disconsolate. I mean, you're completely down. Your confidence is shot. What the heck's going on? No, it's not our fault. Not the signals. We told you. It's a signal idea. We try and get 2 out of 3. You might get 10 bad ones and 20 good ones. I don't know how it works. But if your first 3 are bad ones and you've overexposed, you don't know where you're coming or going. That's what happens. Are we good? Because I'll spend another half hour on this. I don't mind. It's so something important. Because now I'm so pleased you sent that email, Mickey. Because now the feedback I'm getting from some guys who've done it before in the trade room, I'm not getting this base mass. If they're not getting it, trust me, most aren't. And that's what's coming back and biting. It's not the trading journey. It's not the movements of the market. It's not anything, the signals. It's just they're not getting the basic maths of it. They don't know they're driving at 300 when it's actually, they think they're driving at 80. And that's where it kicks. Or they're getting 1 for all. I don't even know what the trades I'm looking at. I might be doing terribly, but let's have a quick look at them. Okay, so let's have a look. Excuse me. Right. That is down. I've been looking at it. This is up slightly. Sorry, up slightly. Okay. Now, what happens here? Look at this. All right, the happened to be 4, about the same. But this is very different. That's 0.4. That's 40 microns. This is only 14 microns. You might see 2.2, 22 microns or something like that, depending where the stop loss is and the specific, symbol or in financial instrument you're in. Okay, and you get my point. I still say I'm going to risk, let's say, 1,800 max, maybe 2 grand, depending on the situation, per trade, and I work it out accordingly. It's not one size fit all. I'm not doing 0.1, whether it be the Dow, the Nasdaq, gold, Brent, silver. No, you've got to work it accordingly. Now, this is down. I'm not happy it's down, but I got my stop loss in. It's within my comfort zone of parameters. It's within the percentage of my account. I'm working discipline on that, and it might come right. If it doesn't, well, it hits a stop. If it comes right, well, I have a blue. And yeah, and so it goes. Now, I've saved my charts, and see, that was a fat finger coming. I don't mind. I've saved my charts. I go to templates, and I go to the one I like. I like this one, and up it, here it comes. Give it a moment. And then what I do, I hide all this, but I don't want it playing with my head. I've been doing it for a long time, so it doesn't play with my head anything like that with you guys, but it still plays with a certain amount. With you, it plays your head big time. Now what? Okay, sorry, just a second.
I think you muted, Roger.
No, sorry, I had to shoot off for a second. Too many cups of tea. I've been holding back too long. Beg your pardon. Okay. Yeah. So I'm back here. Right. Found the cows really useful. Well, yeah, it has to be. You go shopping without a budget? You know, same principle. Yeah, you have to have it. Okay, that's great. Anna Marie, or anything? Right. Explanation all very nice, but do you understand it now? Because you've got to. Martin, Chantel, Dearmore, Edwin, see in front of me. Pretty sure Friday got it. But I mean, other guys, the guys, Nicky, everybody. Oh man, you got it, Chris. Good enough. Pietro, how are you getting it, guys? It's so important. And it's quite a shock to find out so few people understand it. I assume they did. And they're driving, I assume they knew. They didn't. And if you're going to take the trouble and time and have to come to the trading room, I'm going to take the time and trouble and effort to make sure we get this. And you'd be surprised how much life will be a lot less stressful for you. Any questions? I know it's getting 11, but I don't care. This is important. Anybody there still not getting it? I've got the recording there. Go over it again. Write down the questions. Anything you're not sure of, itemize like Nicky does. Keep them handy, and then we do the trade the next time. Bring them up, and we'll go over examples again until it falls into place. Yeah, it is because it's in your comfort zone. And don't come and think I can't take a loss. You're in the wrong business. You will take a loss. Thanks, Nicky. I'd rather you did that and maybe help the other people, because if you continue trading and you continue not understanding it, it's going to come up and bite. And I promise you, it's not difficult. There's a lot much more complex stuff going on in this derivatives market. You believe, unbelievable. It's the Bloomberg sometimes. I don't know what the hell they're talking about. So this is the easy stuff. But we'll conquer this, and then we should be away from start getting it right.
I just want to say thank you to Nicky for asking all these questions, because I think it's helping a lot of people, even some of the more experienced traders, and definitely helping all the novice traders.
Very, very much so. Because I don't think maybe, I assume they know it until somebody comes along and asks it. Anna Marie's quite good at that. Like you, actually, not bad. You'll ask a question. Somehow I think you know the answer, because you think, hang on, that's a struggle I had a couple of weeks ago. I'm pretty sure the others don't know. And I didn't realize they didn't know. And then you get somebody like Nicky or yourself, Peter, Anna Marie, or whatever, coming up with a question. And thank you for doing that, because two other guys don't know the question you asked, or too shy to ask it, or they feel nervous to ask it, or maybe because I speak too quickly they're not their first language. Whether all those are all got to be overcome. And I'm sorry, when it comes to trading advice, I'm sorry, guys, you're stuck with me, because the others are not licensed to give it to you. So they've got to, by law, pass it on to me anyway. So I'll do the best. You can help me out with the explanations, but it's doing it all for your sake, because it upsets me to see a guy who's a nice guy. Most guys are nice people. They are struggling on something that can easily be overcome.
Yeah, thanks, Roger. That really helps, because I was going to go in on USD, JPY, and gold for a straddle trade, one solid lot for each, and that would have been.
Oh no. Well, you couldn't go. You couldn't. You would not be able to go in the dollar yen because you don't have enough margin. On the gold, I haven't worked it out. You might squeeze it in, but you'd be margin called any slight movement. Thank goodness. Thank goodness. Well, you wouldn't be able to get enough money anyway.
So if you go onto if you had to go do that, for example, and then maybe go in a 0.03, but on two straddles, would you halve that to?
Okay, right. You got 10 grand. Okay, right. Let's do the dollar yen. I'm going to work it out for you at 80 pips. So if you want to risk 640 rand, go in. What's 80 rand a pip? You can do it. Do you want to risk 640, 560, 480? 40, 400, 320, simple as that. Just do it up. So do you want to risk 620 rand? Was that too high?
That's fine.
Okay, that's fine. Okay, then you do 0.08 for the dollar yen. This is Chris, his account. If you got 5 grand, it doesn't apply to you. If you got 50, it doesn't apply to you. For a guy with a 10 grand account, and particularly Chris, because he's been upfront, was prepared to risk. You might not be prepared to risk 600 grand. He is. So remember that. So you go 0.08. Let's go to gold. Right. Gold, if you're going to do gold, I'm suggesting on gold, you do $2 above, $2 below. Don't forget, $2 above this price on the buy, $2 below this price. You get the point. $2 above this, $2 below that. So it'll be 1937.50 or 1932.50 or 30 or whatever it is. Okay, right. On the gold, it's only 40 rand a pip movement for whatever way of putting it. So if you're going to go in the gold, you're going for 0.16. Then you're risking a total amount, if they both cop out for you, 640 to 1280 rand. So you go 1.2 on this and 0.12 and 0.08 on the there. You'll cut. Have I got that right? Let's just do that again.
But I can do them simultaneously.
Yeah, you can, as long as you're quick enough to watch them both, because they might jump around different. They're not going to go up exactly the same. One might go faster than the other.
Yeah.
But to do that, what 40 into 600? Yeah, you can go 0.15. So 0.15 on gold. 50, can I make it easier? Say 50 micros on gold, 8 micros in dollar yen, and then you have a total risk factor of just over 1,200 rand on the two if they both go completely sour, which is rather unlikely. I'm not trying to say guaranteed, but it's extremely unlikely. The whole lot's going to go. It's very unlikely. You might move 500 or 600. The whole bloody lot's highly unlikely, unless you panic or you move your stop loss away. But don't put it or do do something daft. But if you've got the concept in your head, the chance of 1,200 rand is very unlikely because if non knocked out, go with the other one, start playing around with it afterwards. If you lose 1,200 rand on those two, I'll look at it afterwards. And then I'm almost 95% certain you've done something wrong your side.
Yeah.
But
now I'm pretty quick. I'm sure I can get it right.
Okay, fantastic. Okay.
Thank you, Roger. That's great.
Pleasure. And you can see now the difference in your position sizing there, because gold is different to dollar yen, different than that. So you get the idea. It's different to Brent. Okay. Peter's quite right, but he reckons he's quick enough. Chris reckons he's quick enough. That's up to him. But for God's sake, guys, we still don't understand the mass computation we talked about earlier on. Stick to one of them. Don't go double. Okay, otherwise, yeah. Do step 1 before you start playing around step 3. 2 o'clock, Martin. I've mentioned before, by the way, I spoke yesterday. I think it was yesterday. No, day before at the office. They're not letting more than 100 in. They can. Simply is because they want to encourage people to be on time. Your argument will be, oh, hang on a minute, I'm on the road. I can't be there till 20 past. I can't help that. It's trying to encourage people to take this serious, be there on time so they can learn the straddle trade. Now you get Chris or Pietro or Farnley, they might know the straddle trade, or Anna Marie. They might come in 15 minutes later. Their worry is not to learn it, to be able to be let in. So I'm sorry, guys, it's not going to be changed. If you want to reserve your seat, rather be there at 2, you learn the straddle trade, etc. And if you know it, at least you're there if you want to be there. Because you might come in at 20 past 2, already 100 people, a few left, well, that's fair enough. If they don't, they won't let you in. You get the idea, because 100 max. So be there at 2 o'clock. But if you don't know the straddle trade, make sure you're there to 2 o'clock so I can go, give me time to go 1, 2, maybe even 3 times. So you get the concept so you can place the trade 5, 6, 7 minutes before the market data release. So they're nicely safely in there, you're not rushed, and then take it from there. And after 2:30 the release, I'll still be here and to sort of hold your hand over the next 20 minutes, half an hour, so just to see what we're going to do after the release has come about. I hope we're all clear. Okay, so 2 o'clock, be there for Martin for 2:30 release. Well, use as many as you like, mate, as long as you're $1. But I'm going to use dollar yen to new people. Remember, I know the score, you know the score, but a lot of guys don't. So I'd rather stick to one and not confuse them. Okay. Thank you, Chris. Thanks for your support. Hope the others are not too bewildered. But I don't care if you will or not. Do not trade unless you understand these stuff. Go over it, ask the questions again, because you've got to get this principle. Otherwise, it's going to be fairly costly. It's not the car's fault. You're just driving incorrectly. See you this afternoon. Sorry I held some experienced guys up in there, but we didn't have any many trades out anyway, so it's probably a good time to do it. Thank you, guys. Cheers. Okay, I'm going to speak to you just now, Martin. I don't see your account with everybody else, so I'll give you a chat privately after this, okay? Cheers, guys. Thank you, Nikki. Thanks for your invaluable contribution.